Hi. We'll begin the webinar now. Good afternoon, everybody. Welcome to the webinar session from Marmor. The topic for the day is assessing fiscal break-even oil price by 2020. I'm Karthik Ramesh. I am the manager of the research division at Marmor. To give you a brief introduction about Marmor, it is the wholly owned subsidiary of Marcus, which is a asset management company based out of Kuwait, which celebrated its 40th year anniversary recently. Marmor operates out of various verticals such as sector reports, industry reports, capital markets, economy, and policy. Today we'll be touching upon a policy sort of economic policy sort of an angle where we're trying to assess the impact of the fiscal break-even oil price by 2020 on the GCC economies. The agenda for the day includes a discussion surrounding how the break-even price is calculated in the first place and what are the various nuances behind the computation of such a metric. We have tried to forecast the BEP values for the next couple of years based on a methodology which we derived from a primary research with leading institutions. Then moving on, we'll look at the implications of this break-even price on the economies of GCC and what's its potential impact on the economies by 2020. So what is this fiscal break-even price? To put it simply, it's the oil price that balances an oil economy's exporting oil economy's budget. While it may sound simple in the first place, there are many ways to get to this number. Hence, there's a lot of confusion between how it is exactly computed. If you see the chart on the right-hand side, there are three different agencies which predict the break-even price for Kuwait, which ranges anywhere between 54 to 78. Now, the causes for these variances will be dealt with in the forthcoming slides. However, it is important to note at this juncture that break-even price is not the price which the oil governments use while drawing their budgets. Oil governments, the governments usually fix an oil price based on various studies which they conduct on their own, and then accordingly they set their finances. Moving on, we did some basic primary research. We contacted a number of institutes to find out how these break-even prices are computed by them. They all gave us a varied responses. Some are very complex, some are quite simple. And but we were able to arrive at a sort of a simple formula which includes government expenditures minus non-oil revenues divided by the quantity of oil produced plus the per barrel cost of production. Now, when we try to analyze why various agencies report different numbers, we could arrive at four different factors for the same. The first being that the forecast for oil production volumes, exports, and domestic consumption vary based on the assumptions taken by each agency. The second one is the historical numbers which are used by these agencies to compute the product or the price, sorry. Historical numbers may vary because the underlying assumptions used by different agencies might be different. The differences in estimates with respect to future government spending is also another key area because as we saw in the formula, government expenditures is a key component while calculating break-even price. Now, if different agencies take different numbers for their forecast, then the price will be different. But a major factor which we found while trying to do our primary research was that some agencies take in investment income as part of non-oil revenues, and some agencies don't. We are not able to exactly say this is the reason why the prices vary by a whole lot, but we feel that this could play a major role while fiscal break-even price is computed. So we use this formula and we try to compute the break-even prices historically. And as you can see in these three charts for Kuwait, Saudi, and the UAE, we were getting close when we included investment income while we computed break-even price. The margin was around 5 to 10%. But when we excluded investment income, our prices were quite high for countries such as Kuwait and UAE. But it did not play a major role for Saudi Arabia. What we feel could be the reason behind that for Saudi Arabia is that Saudi's sovereign wealth fund seems to be more secure and it does not invest in a lot of risky assets like equities, and they play safe and invest in debt securities. However, that might not be the case with Kuwait and UAE. Now, since we thought that our numbers were close from a historical perspective, we decided to forecast the number for the next 5 years. And as you can see, there is a lot of talk in Kuwait, which and the numbers which are spoken about varies from anywhere between $50 to $75. And if you can see the one which I've highlighted, Kuwait, with and without investment income, the numbers come to that range. But the major highlight which I would like to point out here is the numbers for UAE. There's a significant difference between the numbers for with investment income and without investment income when we try to calculate break-even prices, which says that Kuwait should not use this as a or may not use this as a comfort level and try and use their fiscal reserves, and they should accelerate their economic diversification program, which they already are in the process of doing, and they've been fairly successful in doing so as well. Well, in the case of Saudi Arabia, again, although there's not much of a deviation with respect to investment income, they still need to accelerate their diversification program. Now, over the next two slides, I'll talk about why break-even price should not use as a standalone metric while while coming with policy decisions. The three metrics which I have showcased here are fiscal balances, hydrocarbon revenues as a percentage of total government revenues, and fiscal reserves. As you can see, UAE, Saudi, and Kuwait have very high fiscal reserves, especially UAE, with a fiscal reserve of around over $1 trillion, can cover 11.3 times its spending. So it's fairly well placed and fairly well cushioned, even in current low oil price scenario. But if this low oil price scenario prolongs for a elongated period of time, then UAE should try and diversify its economy much faster. But the major point here is the fiscal balance. The only country which IMF predicts to have a positive fiscal balance in 2015 is Kuwait. This is in account of its low break-even price when compared to all other GCC economies. And hydrocarbon revenues, Bahrain and Saudi and Oman are the ones which are highly reliant on hydrocarbon revenues for generating its government revenue. Moving to the next slide, I've looked at another couple of metrics as well, which is share of hydrocarbon GDP as well as non-oil fiscal balance. Non-oil fiscal balance as a percentage of non-oil GDP shows how well your non-oil GDP is used to fund its non-oil GDP. And in this case, it's quite evident that Kuwait and Oman are fairly less diversified when compared to other economies. But from when we look at the share of hydrocarbon GDP analysis, it's quite evident that Bahrain, which is highly diversified when it comes to revenue, is not so well diversified when it comes to it's fairly diversified when it comes to GDP. It's not that well diversified when we look at revenue. So this tells us that break-even price alone as a standalone metric should not be used for policy decision making, whereas it should be a combination or an evidence-based analysis which should be used while framing policies. So the key takeaways from a break-even price analysis is that, like I said earlier, the break-even price can vary due to various underlying assumptions taken by different agencies, and metrics should not be taken on the face value while taking policy decisions. And it is crucial that people analyze the underlying assumptions while looking at the number for taking other decisions. Okay. Now moving on, when we try to assess the potential impact on GCC economies, we try to come up with a vulnerability indicator, which you can see on the right-hand side, bottom right-hand side. And based on those 5 factors which I talked about earlier, we can see that Bahrain and Oman are highly vulnerable to the current low oil price scenario. And Kuwait is the best placed when it comes to the current scenario. This is a combination of various factors such as fiscal balance, the kind of reserves which they hold, the kind of diversification, and so on. But in this current oil price decline, from when you take GCC as a whole, the fiscal surplus, which was around 4.6% of GDP in 2014, is predicted to turn a deficit of 6.3 in 2015. So that is a red flag which all the governments need to look at. Now, what are the implications? The first implication is that the process efficiencies have to be implemented. Technology, when it comes to oil extraction, keeps changing at a rapid pace. So GCC governments must ensure that they keep up with this increase in technology, and they should start investing in getting these new technologies on the ground. Apart from oil production, oil consumption is also a major factor for these economies. For meeting its energy requirement, the GCC economies are highly reliant on crude oil, and they should diversify sources of generation of energy to other sources. Keeping this in mind, a lot of these GCC economies have now started looking at solar power as a better alternative, given that they are geographically well placed to utilize this sort of an energy source. Now, economic diversification is the second implication. Well, UAE has been fairly successful at diversifying its economy. Other GCC countries should follow suit. Uh, Countries like Kuwait have started investing have recently announced its second Kuwait development plan, and it should ensure that the failures which it had encountered in the first plan should not be again repeating in the second plan, and should make sure that projects are done in the correct point of time. The third one is the structural reforms, which there's a lot of subsidy talk which is going around GCC economies in this current low oil price scenario. Recently, Abu Dhabi had hiked its electricity and water prices on a slab basis, which is again a good move. And Dubai from August 1st is planning to keep its petrol and diesel prices in line with the global market prices. So such subsidy measures will definitely help in reducing the expenditure side of the equation for these ECC economies. But for the moment, like I said earlier, there is not much alarm especially for countries such as Kuwait, UAE, and Saudi Arabia, who sit on large fiscal buffers. And also, when you look at their gross debt percentage as a percent of GDP, it's fairly low or very low when compared to international standards. And given that they have a very good credit profile, it'll be easier for them to draw on debt to meet their fiscal requirements. So that with that, I end my webinar session. I now leave the floor open for any questions. Thank you. Okay, I have a question. How do institutions like IMF calculate the BEP? Um, I might not be able to reveal the exact formula because we were not allowed to do so when we conduct our primary research. Uh, but but this is the equation which we could use as a starter while computing our break-even prices. Probably you could email me on my email ID and I'll be able to share more details with you. Yes, I have another comment. On a relative basis, GCC is positioned well when compared to other regions. Yes, I definitely agree to that. When we look at break-even prices for other regions apart from GCC, like the highest break-even prices are for Iran, Nigeria, Ecuador, and Iraq, and Venezuela, which is on the triple digits, higher triple digits. Like for Iraq, it's 120. For Venezuela, it's 120. For Ecuador, is 122. Nigeria is 124, and so on. Yes, so definitely GCC regions are well placed, better placed, relatively better placed when compared to other regions. Yeah, there's another question. Does OPEC have a role to play in setting up? Okay, so the thing is that OPEC does not have any role to play because the number is a calculated number, usually given out by various agencies such as IMF, IAF, and so on. So the government per se does not have a say in BEP. It's based on the calculation which I showed earlier, which is the expenditure minus non-oil revenues divided by oil quantity produced plus cost of oil production. Okay. Another question is when you say vulnerable, what impact it will have, say if oil price crashes to $10? It's a very good question. The thing is that if it crashes to $10, it's not just GCC. I think it will have a worldwide impact. But for GCC, if you ask, then I think, like I pointed out on the vulnerability index, it is Bahrain and Oman which are going to have the worst affected. Then comes Saudi Arabia, and then UAE, Qatar, and Kuwait. So all economies of GCC will have impact, but will get impacted in this order of priorities. Yeah. Another question is there any other way to reduce BEP other than reducing expense? Okay, I think I should go back to the formula now. So BEP can be affected by primarily four factors. One is expenditure, one is non-oil revenues, one is oil quantity produced, and the other one is per barrel cost of production. So it is not just that government expenditures play the major role here. That's why I said if economic diversification is conducted at a rapid pace, then non-oil revenues will come to the fore, which reduces the impact on government expenditure. And also, like I said earlier, if they start consuming lesser oil, which means that they have more oil for them to export outside, which has an impact, favorable impact on BEP again. So it's not just the expenditure which plays the major role in break-even price. Okay. Will the current oil price slide impact BEP calculations for the producers? Again, there is no relationship between current oil price and break-even price per se, because in our methodology, we can see that the oil revenues don't play a major part. So oil revenues is a derivation of oil price as well as the oil exported. So current oil price has to be benchmarked with the break-even price for each country, and then accordingly, government has to take a call on its diversification program and all other policy orientations. It will not affect the BEP per se, but it will affect the government policies. Do we have a break-even price number for the US shale oil? Okay, so break-even prices are usually calculated for countries who are major oil exporters. Since US is not a major oil exporter, we don't have break-even prices for the United States. Okay, thank you for your time. My email ID is there in the slide, kramesh@marcus.com. In case you have any further questions, kindly send me an email and I'll reply to you as soon as possible. Okay, thank you.